Hall & Wilcox acknowledges the traditional custodians of the lands on which this podcast is recorded. We pay our respects to their elders, past and present, and to all First Nations people joining us today.
Hello, welcome to the latest episode in our Equity Capital Markets podcast, focusing on all things ECM. Today, we're going to discuss capital raising pricing restrictions for listed and unlisted funds. And I'm delighted to be joined by James Morvell, partner in our Melbourne office, and by Caitlin Byrne, an associate in our Sydney office. So welcome to you both.
Thanks, John.
So this is sort of a refresher, at least it is for me, on unit pricing rules. So these have been around forever, certainly even before the MIS regime was introduced. Always been more restrictive than rules that apply to companies, which I assume is because an investor in a unit trust is a beneficial owner of an interest in the property, unlike a company. And so where you're issuing units, say at a discount, you're actually dealing with somebody's property. So that the rules are very restrictive, have been liberalised somewhat, particularly since the GFC, but are still very restrictive, particularly in relation to unlisted funds. And so well worth us revisiting. So, James, one of the key metrics in this discussion is NTA, relevant both to listed and unlisted funds, and where there may be opportunities where funds are in the listed funds are trading at or below NTA. Maybe we can just start by kind of recapping on that terminology, NTA, and then maybe any sort of observations on what's happening in the A-REIT space, and particularly where there may be opportunities because funds may be trading at a discount to NTA.
Thanks, John. Look, I think that's a great place to start today, because we do hear of these terms a lot, particularly around registered and unregistered schemes, and a lot of analysts talk, the terms net asset value, which really quite simply means the total assets of a fund less its total liabilities. But to many in the sector, a more pure measure or accurate measure is actually the NTA measure, so the net tangible assets of a fund. And what this takes out is intangible items such as goodwill when looking at the overall value of the asset side of the balance sheet. So to use a simple example, and it's very simple, we keep it simple for lawyers when we talk about numbers. If you have the total value of a fund's portfolio of $100 and the number of units on issue is 100, and we'll take out any intangibles in that value, then the NTA would be $1 per unit, 100 divided by 100. Yep. Then to your question and the observations around where particularly listed funds are trading vis-a-vis their actual NTA value. So what's their issue price on the exchange versus that NTA? There are a range of factors which tend to affect whether they trade at a discount or a premium to that NTA. So for instance, it might be around valuation cycles, particularly around the type of asset class we've got in mind today, which is really real estate investment schemes, or A-REITs as they're often known, Australian Real Estate Investment Trusts. So the valuation cycle is important because depending when the last valuations were undertaken of the portfolio or a significant part of the portfolio, there may be a timing mismatch. The market may have already priced in, John, the fact that they think the office sector has really crashed somewhat, but valuations haven't caught up. There can be, the market can also have already priced in a perception of the way the fund's future earnings or distributions of income to investors may look. So that's reflected in the price, but not necessarily in the asset value itself. Like any stock, be a company or a fund, the market prices in the perception of the way management is performing and the way the entity is likely to perform in the future due to a whole range of macro factors. And then there's the obvious investor supply and demand at any particular time. There might be a real, due to economic climate, investors might be going into a particular type of stock, that has lower risk profile to it, So that can ultimately change the pricing. That's no different to probably any other stock, but it just shows as to why the market will be taking a view on the value of a stock, which may not reflect the underlying assets value themselves.
Yeah. So we are seeing retail assets have traded. It's been quite active trading in the last, say, 6 months, 12 months, in regional and neighbourhood shopping centres, for instance, where they're transacting at less than valuation. To a lesser degree, I guess, in the office space, there's still a long road to recovery there, but seem to be some opportunities opening up in certain grade A grade markets in certain cities. So let's move through then to what are the unit pricing maintenance or issue pricing restrictions. So Caitlin, maybe let's just walk through this. So maybe just start off with, what is the general rule in terms of issue pricing of new units?
Yeah, thanks, John. So responsible entities will often look at raising capital by issuing units at below a NAV-based pricing. The general rule under the Corporations Act is that the constitution of the fund needs to include adequate provisions for the consideration paid for acquiring units. And there was a lot of uncertainty around what would satisfy adequate provisions, and whether this allowed pricing discretion, such as issuing units at a discount to NAV. So in response, ASIC have issued a relief instrument that says a responsible entity can either include provisions expressly in the Constitution that reflect the content of the instrument, or they can incorporate the content of the instrument by referring to it expressly in the Constitution.
And I guess where we started to see a kind of paths diverge between listed and unlisted funds was immediately after the GFC, when the requirement at that stage was that even for listed funds, the issue pricing mechanism needed to be contained in the Constitution, and that included, for instance, stating what was the maximum discount to NAV that units could be issued at, which caused a big problem when, for a lot of REITs hit hard by the GFC, the market prices fell well below the NTA price. So that's when ASIC first gave relief to allow units to be issued at a price determined really by the prevailing market price in those securities, which for listed funds is obviously a more sensible measure, whereas for unlisted funds, really the only appropriate measure is the most recent valuation of the real estate. So maybe let's just look at the exceptions that apply to listed and unlisted funds to allow, under the current rules and the current instrument, to allow units to be issued at a price less than NAV. So maybe we've just run through those. So
the ASIC instrument says that the constitution of the fund does not have to make adequate provisions where it contains provisions that allow the responsible entity to set the price of units to be acquired in certain circumstances. So this can include units that are issued under a rights issue. So the responsible entity can set the price where the units are being issued under an offer to existing members in proportion to the value of each member's interest.
So that's obviously fair to all of the members if there's a discount, because everybody's getting the benefit.
Yes,
the benefit of that. Yeah.
Another example is where units are issued under a distribution reinvestment plan. Which again
is the same thing, I suppose, that everybody can take advantage of that, so nobody's being disadvantaged.
Yeah. Or where interests that form part of stapled securities are being acquired, if the Constitution contains provisions for the amount of consideration to acquire those stapled securities.
Yeah.
From an ECM perspective, you can get this additional relief for the issue of interest listed registered schemes by way of a placement.
Yeah.
So similarly to units being issued under a rights issue, there is relief for interest that are issued or offered under an interest purchase plan. So that's where the interest offered to existing members of an ASX listed scheme, and members can acquire interest at less than the market price, like you said, based in the 30 days, the market price 30 days prior to the date of the issue.
Yeah. So for placements, other than restrictions under the listing rules, which we'll come back to, there's really no restriction imposed by the ASIC or the Constitution on the price. Because the directors of the RE will set the price by virtue of the market.
Yeah.
Whereas a placement for an unlisted fund, there is still a restriction that unless unit holders not all agree, but pass a resolution to approve the placement, the issue can't exceed more than 50% of the units in the relevant class. So there's protection there for the unit holders against dilution.
Yeah, exactly. And also there's restrictions on like the minimum issue price. When you've exceeded that placement capacity, you can the minimum price must be at 75% of the VWAP calculated over the previous 15 trading days.
Yeah, so that's under the listing rules. So maybe just to recap on the restrictions under the listing rules. Under the general restriction under Chapter 7, a listed entity may issue up to 15%, generally speaking, up to 15% of its capital without unit holder approval, except for funds covered by listing rule 7.1a, which can issue an additional 10%, but the minimum issue price must be 75% of the VWAP over the previous 15 trading days. Yeah. Are there any other restrictions, Caitlin, in the listing rules that we should be aware of?
Yeah, so if you want to issue interest to make up a shortfall on any pro rata issue, again, to existing unit holders, that issue price must be at least the same price at which they were offered in the pro rata issue. And another example is for on-market buybacks. A responsible entity can only buy back its interests at a price which isn't any more than 5% above the VWAP, and that's calculated over the last 5 trading days.
Yep, very good. Caitlin, any other observations or comments on the distinction between pricing discretion rules for listed schemes and unlisted schemes?
Yeah, so for unlisted registered schemes or ETFs, pricing is based on a similar formula, being the value of the scheme property that's attributable to interests in that class, less any liabilities that may be met from that property, and then dividing that number by the number of interests on issue. So it's essentially a NAV-based pricing specific to the property attributable to that class. If the responsible entity exercises any pricing discretion under the relief instrument that we mentioned before, the methods that they use need to be consistent with ordinary commercial practice. And it needs to produce a price that's reasonably current at the time of the issue.
Yeah.
And then, as always, the responsible entity needs to be acting with the same degree of care and diligence that a responsible person would exercise if they were in that position.
Excellent. Well, thanks, Caitlin. Yeah, that's sort of been a good reminder to me of rules that, as I say, have been there for a long time, but they have evolved sort of somewhat over the years. James, anything else you'd like to add?
Well, no, I think it's just that it's a timely, probably reminder of some of these provisions and these rules, because I think there is some optimism around the AREIT sector at the moment, and we do hear from a number of analysts who are spruiking AREITs for investment. It's fairly evident, not that we're economists at Hall & Wilcox, John, but it's fairly evident that the RBA and other central banks are certainly beginning or at the nearing point of reducing interest rates. And history suggests that it's the REITs that tend to benefit from such conditions as their borrowing costs decrease. So these are typically all leveraged structures that use debt in addition to equity to acquire real estate assets. So that's something which we think will be favourable to the REITs. Other factors around sort of the asset classes are probably relevant just to touch on. So you think about office, it seems anecdotally and from what we read and hear that a number of Australian businesses and some quite large ones are winding their flexible working arrangements back. So what
Yeah.
that's likely to lead to is, higher occupancy rates in office. There is no doubt, and just speaking to our own colleagues at Hall and Wilcox around migration in this country, there is very strong migration persisting. We're very active in it, but we see it everywhere. We see stories and articles about our capital cities increasing in population over the years. So, these are only going to help real estate-backed businesses, and in particular, these funds, which are helping sort of the development of new real estate across different classes. You mentioned, John, interestingly, around retail, and it's, I think, tends to be almost quite geographical in sort of the way it has perhaps revived since the pandemic, but there's opportunity there. So, at the moment, there's some pretty good discounts which seem to be available on some of the REITs, and as the cost of capital sort of improves, I think we would expect, based on history, that there'll be more activity in REITs, acquiring assets. I mean, John, you've been, as you said, around this part of the market for many years, despite your youthful appearance. Would that be your expectation as to the cycle, that again there'll be more acquisition activity and capital raising?
Yeah, it is, and I think we're starting to see the sort of first signs of that. Yeah, obviously, expectation is that we're entering a more benign interest rate environment. So I think the transactional activity, is likely to increase. Yeah.
In which case, Caitlin's very poignant tips on unit pricing will become even more important.
Absolutely. Very good. Well, Caitlin, thank you very much for that. James, thanks also. And let's leave it there until next time. So thanks everyone for listening today. As always, please get in touch with us if you have any questions. You can find our details on our website, which is hallandwilcox.com.au, or connect with us on LinkedIn. If you enjoyed today's episode, then please rate, review, or follow our podcast wherever you get your podcasts. Thank you.
This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.